Elon Musk tweeted out that his Twitter deal was on hold as a result of an investigation that he wanted to do over the possibility of the potential that Twitter could have a fake user problem. And that news sent the shares cratering. But what his tweets really did was it completely changed the math for this potential arbitrage opportunity. And that's what I want to cover in this video, because I actually think that there's a potential for an almost 5 times return on these securities, and I'll break it all down for you. So guys, smash that like button and subscribe if you're new. You're watching More Money. Let's get it. What's up guys, and welcome back to the channel where the goal here is to help 1,000 people achieve financial independence much sooner. And let's dive right into this. So you can see here that the Wall Street Journal reported that Elon Musk actually tweeted that his Twitter deal is on hold, and of course that sent the share prices declining. But what I want to point out to you is that throughout the week, Twitter's share price actually has been declining. And I kind of been watching this because I wanted to see if the share prices will get low enough where there's a reasonable arbitrage opportunity potentially on this deal. So what this share price decline could potentially mean is this a potential gift to arbitrage investors? And that's what I'm going to try and investigate with you in this video. I actually believe that it could be a really decent gift if the spreads on the call options make sense. Now, backing up for a second, you can see here that Elon Musk stated that his Twitter deal was temporarily on hold because of concerns about fake accounts. And what he did was he referenced a recent Twitter disclosure about fake and spam accounts. But here's the problem, and the Wall Street Journal points it out. Elon Musk has already signed an agreement for the purchase and waived due diligence on the deal. Now look, I can't buy a house and waive all conditions and then go back on my first visitation of the house later on and say, oh, there's a crack in the foundation, I'm not buying it. My time to have done the due diligence was before I signed that dotted line. Elon Musk is in the same situation. I don't think Elon Musk is able to renege on this deal as a result of those fake accounts, especially considering that this is something he's already known about. And you can see that the Wall Street Journal even pointed that out. At the bottom paragraph, it says that Mr. Musk was aware of questions about fake and spam accounts on Twitter when he agreed to the acquisition. He has even raised concerns about this in his own tweets for years. So I personally don't think that this is a reason why the deal is going to get closed off. And he even actually sent a tweet afterwards saying that he's still committed to getting the deal done. So even from Elon Musk's perspective, or at least what he's been articulating to the investment community, he's still going ahead with this deal. Now, some people will actually say, hey, hold on a second. This tweet could be seen as a disparaging tweet towards Twitter. The Wall Street Journal actually pointed that out in the article. You can see here that Mr. Musk's initial tweet Friday could be seen as critical of Twitter. Now, why does that matter? Because the merger agreement stipulates that he can tweet about the deal so long as he doesn't disparage the company or any of its representatives. However, I personally think that asking for backups for a 5% calculation is not disparaging the company. It's being prudent, and it is something that he's allowed to do. Where the problem comes is that why didn't Elon Musk just reach out to management for the support? Why did he have to make a public tweet? That's what's weird about this. And it makes me a little bit iffy about what his real intentions of that were. Now, there is a short seller that came out and said that the Twitter deal is overpriced and said that there's significant risk that it could be repriced lower. Now, Elon Musk actually saw that and said, interesting. Don't forget to look at the bright side of life sometimes. So of course Elon Musk could not resist to troll this guy. But that being said, that short seller raises a good point. Is the deal actually overpriced? And honestly, the only way to really tell if this deal is overpriced is to really do a valuation for yourself. And there's one really important item that you have to adjust for if the company is going private. And lucky for you guys, you're looking at a guy crazy enough to have a whole slew of models, including Twitter, ready for just this time. So you can see here that in my free cash flow per share valuation for Twitter, I'm actually valuing the company at $79.50 a share. Now, the reason why I'm valuing the company at $79.50 a share is because I'm assuming that there's no more stock-based compensation paid out to the management team once this company has gone private. So in Elon Musk's hands, this company is worth a lot more than it would be worth in my hands as a small shareholder, because the management team has just been paying themselves so much here. So it's a different valuation for Elon Musk. I don't think Elon Musk has a leg to stand on if he says that the valuation is too high, but also he couldn't even do that anyways because he's the one who offered the price. And then of course subsequently waived any due diligence. So none of that makes sense here. I do not believe that this deal is going to get reneged on, nor do I feel that the price of this deal is going to decline. Now I'm about to go into the analysis of the repriced option opportunities where I actually saw a potential of an almost 5 times return. But before that, you guys can see here that you can access all of my research for just $5 a month at the Patreon. And if you decide that it's not for you, in the first month, I'll give you a 100% refund, no problems. But I do want to point out, the Patreon has a greater than 100% retention rate, which is because more people decide to upgrade to the monthly call tier than they do actually canceling. So it's really good, and it's showing that there's real value here that people are finding from it. So please give it a try if you haven't. Now, moving on to the options opportunities. You can see here that I do want to start out by saying that this is not financial advice. Options are extremely risky. And the whole thing about options is that because this Twitter deal can fall through, by using a call option spread type opportunity, you can lose 100% of your investment. So I don't recommend this to anybody who doesn't truly understand options. But what I'm really doing here is just showing you my research and what I found. So with this call spread analysis, you can effectively buy the 52.5 call options and sell the 55s. Note that once the deal goes through, you're not going to get $55 per share. You'll get that $54.20. So you lose a bit of that. So you do have to adjust that when you model this call spread out. And you'll see that I did that right here. So you can see that the selling price is $54.20, which is what Elon Musk offered. Now, you can see that the call buy side strike price, the $52.50, the options premium is $1.78, which is exactly what we saw for the premium in the previous screen. And then I just want to pause here and note that the sale price of the securities, the $54.20 minus the $54.28 gives you a negative 8 cents. So note that you're actually losing money on the naked call. So the opportunity here isn't to purchase a naked call. The opportunity is to purchase a call and sell a call at the same time. And effectively, it's a covered call because you have access to the shares, and your brokerage will just put them together because they're the same strike date of January 19, 2024, which is far enough into the future that hopefully the deal gets closed by then. But that being said, for the $55 put that you can sell, the option premium that you can generate is $1.20. That's a January 19, 2024 call option. So the net earnings that you can make on this is $1.12 per share multiplied by the number of shares that you represent when you purchase any of the contracts. But that being said, the total cost for you is approximately 58 cents because you'll pay $1.78 per share to purchase the call and you'll get back $1.20. So the spread for you is 58 cents. So if you were to do $50,000, you can purchase approximately 862 contracts, and that yields you a net profit of $96,000. However, Elon Musk is a wild card. So if I'm going to enter into this type of opportunity, I want to see something close to around 5 times. So my upside is 5 times and my downside is, of course, 100%. So that's kind of the type of opportunity that I want to enter into. I was able to do that with Activision, and earlier this week when Alibaba's share price went down to around $80 a share, I was actually pricing out something similar to that with Alibaba as well. But moving back to this, you'll note that earlier in the day, I actually saw the 52.5s selling for $1.60, and the 55s I could have sold for $1.30. So that gave me a total spread cost of 30 cents and a total potential return of $1.40 per share. And so what that really meant was that on a $50,000 investment, I could return back $233,000. So that's the type of opportunity that I'm looking for here. And I'm going to continue watching this like a hawk because I personally wouldn't mind throwing 50 grand at this if that's sort of like the opportunity that I'm seeing. But once again, I have to stress that this is not financial advice, and options are extremely risky. So always talk to your financial advisor and never take advice from anyone on YouTube, including me. Now, with that said, if you guys aren't up to date on the Twitter situation, I did a complete deep dive into it, which you can get to right here.